And we'll get started here with our last session for governmental accounting, which is Chapter 16, Accounting for Healthcare Organizations. We're just going to kind of gloss over the chapter and do some journal entries. If we had more time in the classroom environment, I would definitely go in a little more into the financial statements. However, I feel like you students are intelligent enough that if I were to give you a adjusted trial balance, that you could create the financial statements based off of, if I gave you a skeleton statement, you could plug in the pieces because you're that smart and you realize how accounts work. Anyway, let's start off with a quick devotion. This is from Nicole, and she lives in California. It says, when my son was 10 years old, he had an ant farm. He kept it on the kitchen counter where he could observe the ants' progress each day. Ants are tidy. They made a trash pile on one side of the farm and kept their food on the other side. Ants are creative. They reshape tunnels as their needs changed. Ants are collaborative. All ants were working together, seemingly sharing all tasks. My son sat for hours watching the ants build and rebuild the farm. I wondered what he was learning from the ants. Certainly, he could learn that teamwork is necessary for success, that sometimes it's a good idea to change directions in your path, and that putting your trash away keeps your world tidier. He also learned that I hope he also learned that there is something inherently good and beautiful in work. God designed all creatures for work, so let us learn from the ants. Okay, so thank you, Nicole from California. Nice little message there that we can all learn from ants. Work together, work hard, and keep your trash away from. Keep your world tidy, right? Of course, my desk is a mess right now, so I'm doing a good job of that. All right, so let's shrink it down, and let's talk about healthcare organizations. This is Chapter 16. What you see here on the screen is a chart, and it kind of goes over. This is actually pretty similar to colleges and universities in terms of who's in charge, right? So what we learned in Chapter 15, we learned that the for-profit colleges, and there are some, University of Phoenix, Full Sail University, and some others. I think like Virginia College and what's the other one I see on TV all the time. Most of what you see commercials for are for-profits. Not Strayer. I don't know. Anyway, you'll see if you see them on a commercial, it's probably a for-profit college university. But the for-profits and the private colleges were both under control of GASB. Remember, the private colleges are pretty much nonprofits, and then the public colleges, which were governmental in nature, they're under GASB, okay, as opposed to FASB. It's kind of the same thing here. You've got, and you see here on the chart, are for-profit hospitals and healthcare organizations. They're owned by investors, similar to like a stock. Okay, you have stock in some certain hospitals because they're for-profit entities. Then when you get to the realm of nonprofits, you get to either business-oriented, which essentially are going to be sponsored ones. I see a lot of these, Shriners Hospital. Obviously, the Shriners have had something to do with that. Religious organizations. What's that? St. Francis. I think it's a Catholic hospital in our area. I think. If not, there's definitely one down in Charleston. The Roper St. Francis down there would fall into that category. Then there's also governmental nonprofit hospitals. And again, I always go back to Orangeburg. It's called the Regional Medical Center of Orangeburg and Calhoun counties, and that would be a more of a governmental one there, right? So it's more of a governmental, not-for-profit hospital. So that's going to get us to our first question of the week, and that is to name the nearest hospital to your location and put in which type it is, if you can figure that out. Okay, so I'll put that up as soon as I get done. I'll put that up. So week 5, question 1. name the closest hospital to your location or your where you grew up, I guess, your house that you grew up in, and list which of the three it might be. Okay. Regardless, just like the last chapter, the for-profits and the not-for-profits that are not governmental, these two guys are under the guidance of FASB, and the governmental will be under GASB again. Okay, so over here we'll see some of that same wording with the donor contributions with restrictions and without, and so you won't really see that over here. Okay. So, and then also in terms of percentages, the book says down here, where's it at? Oh, it's above it here. It's below it in my textbook. Over half of the non-federal, so federal would probably be the VA, right? That's the Veterans Hospital, and that's federal. But over half of the non-federal hospital health care is provided by not-for-profit organizations. It doesn't give us an exact number, so maybe we'll say 60%. It's just an estimate, or a guess, really. And that would leave, and it says here, the remaining care is equal number of governmental and for-profits, okay? So if... This is an if, okay? So whatever it is probably going to be close. If it's 60% is for profit, then roughly 20% would be. Let me try it again. If 60% is non-governmental, not-for-profit hospitals, then roughly 20% would be for-profit hospitals, and then the other 20% would be governmental, not-for-profit hospitals. Okay, hopefully I got that right. I think I did. All right, anyway, it doesn't always have to be hospitals either. Down here you see other types of healthcare organizations that are not just hospitals, and you can look at that: nursing homes, drug and alcohol rehab centers, etc. Okay? All right, let's keep going. Reporting. That's down here. No, it's not. It's talking about, this is kind of what I was going over, that FASB does for-profits and non-governmental not-for-profits, and then GASB does the governmental not-for-profits. So we'll skip that one. Here. This lists the required financial statements, so this is pretty important. Okay? For our not-for-profit healthcare organizations, which will also include the for-profits, balance sheet, statement of operations, which again is kind of like the income statement, kind of, not really, cash flows, then a statement of changes in net assets, and net assets essentially is equity, okay? So it's kind of like the statement of equity, okay? And then for GASB, we've got only 3, because we're going to kind of combine 2 of them, right? Essentially. So for GASB, which is governmental healthcare providers, we got statement of net position, which, again, is balance sheet-like, okay? We got a statement of revenues, expenses, and change in net position. So this is kind of like the income statement and the statement of equity combined. And then we got the statement of cash flows, okay? There we go. So there's your required statements for both of these guys. All right, let's move forward to some of the key topics. Let's go to revenues. Clearly there's some stuff here you might want to look at. And we'll cover some of this information, like the receivables is fairly important here. So maybe come in here and check out receivables. What's important there is... well, we'll get to it with revenues, because they do go together, obviously, right? So if you do debit revenues, or sorry, credit revenues, you're probably going to be debited into accounts receivable, if not cash. So here's revenues, okay? So this is 1, 2, and 3. These sentences here are quite important. Let's highlight them real quick. Healthcare organizations receive the majority of their revenue in the form of fees for service, which makes good sense, right? Now, yes, they have some other revenue. Okay, they have a cafeteria that people go to and eat. They have little gift shops where you can buy flowers and teddy bears for people that are in the hospital, whatever else. So yes, that can generate some revenues too. That's going to be other revenues, but that's going to be a very small percentage. The vast majority of their revenue comes from fees for services. Okay, the principal sources of service revenue are patient service revenue. Maybe we can re-highlight this. Can I do that? No, I can't. It's fine. Patient service revenue. Okay. Premium revenue derived from capitation fees. What happens if I do that? Fixed dollar amount of fees per person paid periodically by a third-party payer to a healthcare organization regardless of service fees provided. All right. Okay. I'm assuming that is something like a nursing home fee where you pay a dollar amount per month for that longer term care. And then down number 3, which sounds very similar, so I may be a little confused here, but it says resident service revenue such as maintenance or rental fees in extended care facility. So I don't know if that's kind of like adding on to number 2, like if you're in a, or if that's kind of a, if I'm looking at apples and oranges there, I'm not positive. But regardless, what we're going to cover in this class will be number 1 for the most part, which is patient service revenue. We don't want to get too complex with an online environment. Anyway. Excuse me. Now, what we will do, okay, it says right here, service revenue is recorded at the gross amount, okay, when it's rendered. One topic with hospitals is you can kind of charge whatever the heck you want. Okay, now, does that mean you're going to get it? Oh, heck no. Okay, and I'll explain that in a little bit. So, if you wanted to, maybe, I don't even know an example here. Maybe they're going to do a arthroscopic surgery on somebody's knee. They might charge like $200,000. But Medicare, which is going to cover this surgery, is only going to cover a certain amount. Maybe it's half of that. So even though they charge $200,000, they're never going to get more than $100,000. Okay, so yeah, you can go ahead and put the $200,000 on your income statement and accounts receivable, but when it comes down to it, you're only going to get that amount that Medicare is going to pay. Okay, and so what will happen is, yeah, when you first put in that revenue at the gross amount, that's fine, but whenever you'll have to, at some point, you'll have to do a contractual adjustment. Essentially, you're going to have to, and that's going to be a contra. You see it right here. It's a contra revenue. Okay, that's going to offset. It's going to offset that gross amount of service revenue. So we'll report service revenue at a net amount, which will be whatever you decide to charge minus the contractual adjustments, which will be much more in line with what you're going to get. Okay. And you see an entry here where you've got a debit to contractual adjustments and a direct credit to accounts receivable. So this would be a contra revenue here, which will offset, in this case, it's that $125,000 charge, because they're only going to get paid $75,000, which you see down here. Okay, which will be what they're actually going to end up getting. All right. Down, and this is mostly based off of this sentence here, what I just said. Under Medicare's Prospective Payment System, PPS, payments are based on allowable service costs for medical procedures within the same diagnosis-related group rather than on the length of the patient's hospital stay or the actual cost of services rendered. Okay, so they're going to pay a certain amount for that certain surgery. If there are complications, then they're not going to pay more. And that's why, and it's kind of a bad thing, sometimes you see where hospitals are trying to get patients out of the doors because they're losing money because they're only going to get the contractual amount if there are some minor complications. Now, if they're major, hopefully they're going to do what they need to do, which is deliver excellent health care. But if it's minor stuff, or they're going to try to get you out as fast as possible for that reason. Okay, what charity? Okay, this is important too. All right, I'll check this out real quick. Government and not-for-profit healthcare entities are expected to provide some level of charity care. Okay, services, which is services with a person is, services to a person with a demonstrated inability to pay. Essentially, poor people are not going to be turned away when they walk into a hospital if they need medical care. Because charity services are neither expected to result in an inflow of resources. Okay, remember, when you deal with revenue recognition, obviously it's, you record it when the goods are delivered or the service is provided, as long as, that second part you kind of forget, as long as you expect to be paid for it, okay? If you don't expect to be paid for it, then that really questions is like, well, do I recognize the revenue because I'm not gonna ever receive it, okay? And so here's some rules here. Because the charity service is never expected to result in an inflow of resources, it is recognized as neither revenue nor receivables nor bad debt expense. Therefore, if the health organization policy is to not pursue collections of amounts determined to qualify as charity, those amounts are never reported as revenue. Okay? There you go. Although it says here standards do not specifically address disclosure requirements related to charity care, it requires that healthcare entities disclose their policies for providing charity care. Okay. Here's that other revenue and support, auxiliary sales. Again, we're talking. I put it here in the. I'll go ahead and highlight these. We do the whole part. Other revenues include, right, and that's going to come all the way down to here. So those are worth reviewing. Okay. Medical supplies to non-patients, meals for the cafeteria. Maybe they have an education program where they can come teach CPR to a class. Or I remember when I was doing coaching, we would have somebody come over from a healthcare organization to do a CPR class for all coaches. And so that the charge for that would be other revenue, stuff like that. All right, where are we at? I think, a little more. So let's look at one thing here. Now there's a nice list. Okay, it's on the next page of illustrative journal entries. So this one, and it goes down to about 25. There's a lot of them in this chapter. And these are, what does it say? It says nonprofit, right? Not for profit. So it's not governmental. So you may see that with and without user restrictions. All right. Let's look at this first couple entries real quick, and then we'll go to the quick study, right, or the end of chapter questions. So here it says gross revenues. Okay, gross revenues for patient services. Total of $9.261 million, right? So $9,261,000. And so here you see that entire amount going into patient service revenue. We haven't discussed whether they're going to receive it or not. We're just saying, hey, okay, we're going to record all that revenue, and there you see it. And then down here we have some contractual adjustments. Okay, at least it's not a very large amount. There's some, right? And there's also some bad debts being written off using the allowance method. So in here it says estimated provisions for bad debts is $180,000. Okay, so that would be one part of the entry, and they kind of combine it. It's just two entries in one. And then they got the contractual adjustments, okay? And then let's see what accounts are affected. See if I can put something in pink. All right, so the estimated provisions for bad debts, okay? Well, that's going to be you hit an expense account, and then you credit the allowance, right? And you see that here. Here's the debit to the bad debt expense. It's just called provisions as opposed to expense, okay? And then down here you see the credit to the allowance, okay? The second part, the contractual adjustments, we discussed that earlier, okay? The contractual adjustments is a contra revenue, which will lower this here by, so we got to do a debit to a contra revenue, which will net with the patient service revenue. Okay, so there's that debit, and you see the direct credit to accounts receivable. Okay, now the rest of these are worth looking at individually. Okay, I looked through them, and I don't think I need to spend a bunch of your time me talking about it because you're smart enough to kind of understand these. There's nothing here of any huge difficulty. There are 21. I recommend you looking at them. Anyway, actually, here's some closing stuff at the end as well, but we probably won't go that deep. Anyway, excuse me. Let's do some work, some actual entries here once we do a couple of multiple choice questions. So here we go. These ones are pretty easy too. I picked some easy ones. We got 3 multiple choice questions. A not-for-profit hospital would present all of the following except. Okay, and we actually highlighted that already. Let's go back to it. I think it's here. Yeah. All right, so balance sheet, statement of operations and cash flows, and statement of, so they're pretty much the 4 financials that we're used to. Okay, so there's the balance sheet, yes. Here's the statement of operations, which is kind of the income statement. Okay, and then there's cash flow statement. So this one here is actually this is under the GASB. This is the one. Let's go back to it. GASB down here for our governmentals. That's number 2, which is kind of like an income statement combined with a statement of equity. Okay. Up here, this is kind of this number 2 is our income statement. Number 4 is our equity statement, loosely translated at least. So that's that one. Number 2, fees received by a hospital for a healthy heart workshop. Okay, and I think I pointed that out too, right? Under revenues, well, kind of. Okay, I mentioned it at least. Down here. There we go. That would kind of go into this. Where's other? Here. This auxiliary sales, which would be like an educational program. Okay, so this Healthy Heart would be an educational. This Healthy Heart workshop would be a educational program, which would be in other revenue. Okay. And then we go to number 3. Why are healthcare organizations motivated to track actual cost of services? Okay. The amount that you're going to get for any procedure is predetermined. Okay, so the reasons you would want to track actual costs is so you can determine whether or not you are making profits on different procedures. If that makes sense. If you're going to get if you're going to be reimbursed for Medicare $100,000 and you track all your costs for that surgery and the surgery is like $115,000, and you lost money providing that service to a patient. Okay. And it's this one right here, right? Third-party payers contract with the organization to reimburse a set amount, and the organization risks a loss if costs are greater than the amount reimbursed. So that's very straightforward. And so you want to track each individual case and make sure you're making money on those cases. And if not, what can we do to make money on those cases? Okay. Because charging more is not the answer. But why? Because you're going to get a certain amount from the third-party payers. Okay. So this is a series of unrelated transactions involving the hospital. Okay. And A is a not-for-profit facility, and B is a governmental facility. Okay, so we got FASB up top, GASB on the bottom. Okay. The first thing is a reservation of some cash. The hospital has a contractual agreement with a lender, so it's like a debt covenant, that $500,000 must be set aside to meet future debt payments. So we have to have a reserved cash stockpile of $500,000. Now, obviously, hopefully you can think, well, we got to take $500,000 out of cash. So there needs to be a credit to cash, and there will be for both of these transactions. Okay, so for A number AA, okay, or A1, there's going to be a credit to cash. Now the top is, it's somewhat tricky to get the label. Okay, so if I typed in cash, what do I see? Okay, and it's either these two answers. So the first one here is going to be assets limited as to use. Essentially, it's fancy wording to say it's reserved cash. It's cash that we can't spend. And so that's what we're going to use up here. And I messed the bottom up, so there we go. That looks better. So for the FASB, we'll use assets limited to use cash. And then down here for GASB, yes, it's still going to be a credit to cash for $500,000. And up top here, we're going to do, we're going to use the other one, this bond repayment cash, which is another way to say this is limited to only be used for bond repayment of $500,000. So really it's the same thing, it's just different, the debits are differently named. Okay. The hospital accrued $150,000 in patient services. Okay. There's some charity services also provided, and there's a contractual adjustment for $535,000. All right. So remember, the credit to patient services needs to be this. Okay, this is here. This is just trying to throw us off. Okay, it's not revenue. We don't deal with that. Essentially, it's not going to show up anywhere. Okay, we're going to that's kind of the trying to distract you. What is important is the recording this at the full amount. So we need a credit to patient services revenue. Was that 1.5 million? Okay. Okay, so then we need to have because it's a accrual, it's a receivable, no cash. So we'll do a receivable. Okay, and that receivable, where's my phone? I need my yeah. All right. So we got to figure out the $1.5 million minus the contractual adjustment of $535. Okay, so this amount is our accounts receivable, $965,000, and our contractual adjustment will be that stated amount of $535. Okay, so that is how that's going to look. So what we've got here is the full amount of revenue that they charged. This is a contra revenue that will net this. So essentially the net revenue is $965, and then the accounts receivable is also $965. Okay? Let's see how it looks on the other side. Same thing? Yeah, same thing. Exact same entry down here. Let me put it in real quick. Let's see. Accounts receivable, $965. Contractual adjustment, $535. And then patient service revenue, $1.5 million. Beautiful. Let's go to C, bad debts. Okay. So remember, we're using the allowance method here, and these are going to look the same as well. As opposed to calling it bad debt expense and then a credit to allowance, we're going to call it provisions for bad debts. So provisions for bad debts, $45,000. Allowance for uncollectible receivables. Okay. Oh, too many zeros. But that one's easy, right? That one, I think you'll find that one easy. Same thing down here. So provisions for bad debts. Allowance. Okay. Okay. Donated services. Now, I forgot to cover this in the chapter. Let's see if I can find it real quick. I remember reading it. Here we go. It's right down here. Good. So, FASB requires materials amounts of donated to be reported at fair value. And also it says requires a recognition. This is the important part. FASB requires a recognition. I'll try it again. Recognition of contributed services at their fair values if the services received create or enhance non-financial assets or require specialized skills that are provided by individuals possessing those skills and typically would need to be purchased if not provided by donation. Okay, that's huge. Okay, and then down here, but look at this. For governmental, though, do not provide recognition of donated services. Okay, so for FASB, you can have donated services. You cannot for GASB. Okay, and that's important here because what does it say? General services of $100,000 were donated by technicians. Normally, the hospital would have to purchase these specialized services. So for FASB, we need to, this is going to be an expense that's offset by a revenue. Okay? So, we got some general services expense, $100,000. And so now we're going to have some sort of contributions. Okay, now there's no restriction on here because they're already matched up with what they were for. So where you have contribution, so it's like revenue without restrictions. That has to be that donation. Okay, so that's that donation of general services. So you see, there's the expense and it's offset. Down here, we don't recognize it. Okay, so there's nothing. No journal entry required. Okay? Strange, right? Alright. An endowment contribution was received. So this is going to be what? Cash coming in. Sounds reasonable. And of course, we know that these definitely have restrictions. That's the whole thing about... Oh, probably do permanently, huh? No, it says do with. Okay. So not per restrictions, but with restrictions. Okay. And it depends on what those restrictions are as to how you release them. And then it's going to be similar for the government, but a little bit worded different. So we'll still have that cash coming in. But then we'll call this is going to be more like a general, like a revenue. Ooh. What was that last thing? No, that's not it. Let's see. Revenue. Oh, wait. This is it. Here we go. This looks good. Contributions for endowment. Beautiful. Okay. Let's go on to F. Investments. Appreciation of investments. All right. So what we're going to do is kind of like what we do in for-profits as well. I used to teach this back at Principles too. But back then you didn't record unrealized gains You would record losses, but not unrealized losses, but not unrealized gains. But here we will do those gains. So if we have an increase in our investments, so we'll have to do a debit to our investments of $32,000. Again, this is unrealized, right? Because there's no real gain there until you actually sell it. So we'll do that for our governmental, or I'm sorry, not-for-profits or non-governmental not-for-profits. And then down here, we'll do something similar. Investments. $32,000 increase. And then we're going to call that a revenue. Changes in fair value of investments. Okay, so similar, but a little bit different. Okay, that gets us to G, a purchase of equipment. Okay, record the purchase of equipment. What does it say here? The hospital purchased equipment with resources that had been contributed in prior years for such a purchase. So they used to be contributions with restrictions. We're going to release those restrictions. Okay, so that'll be a part of this. At least for this, will be for the FASB or the not-for-profit facility. So this part's easy. We're going to have the equipment. Put that Q in. Okay. How much is it? $837. And we're going to use cash to pay for it, right? But whenever we do this, because it was reserved in the past, now we need to essentially unreserve it, right? Release it from restrictions. And that's what Part B is for under the FASB, okay? So we're going to do their net assets released from restrictions. And then we can put it into net assets without, okay? Released from restrictions without donor restrictions, okay? So very confusing, but that's how we do it. After you do it a few times, it's not too bad. And then down here for the government, for Gatsby, all we gotta do is just do the purchase. The equipment, $837, and then the cash. All right, there we go. Let's check our work. Uh-oh. I got some. Oh, I gotta get ahead of myself sometimes, right? That's supposed to be with. That's supposed to be cash. That left a zero out there. Let's fix these real quick. This one's good though. So I just made sloppy errors. All right, so let's fix the top part up here. Remember here, see I didn't get my numbers right. Okay, this is where I went too fast. This is with the cash, not limited. This is be with restrictions. Okay. Yeah, what? One more problem? Yeah, this is cash, right? Easy. Oh, did it again. Now we got it. All right, fix my layers. Happy up top, happy at the bottom. Let's go number 5. We can wrap this thing up. So 5, they're all related. They are revenue related too. So not only is it they kind of go together, but they're all for not-for-profit healthcare. So no government involved. It's just FASB stuff. And here we go. Okay, we got to make some entries. We got to do some, figure out our revenues. Okay, easy peasy. All right. Services provided to inpatients. So this needs to be our big credit, right? Our big credit, patient services is right there. This is ignore because we don't record this. And then it says, this is cash from uninsured patients. And then this is going to be billed to Medicare and whatever else. Okay, it's going to be receivable. Okay, all right, let's do it. So patient revenue. Let me type in the T. Patient service revenue will be the full $9.6 million. Some of this was cash from uninsured patients. We'll put some cash in. That'll be $928. And the rest is going to be a receivable from those third-party payers. Let's figure that number out. $9.6 million minus 928. About $8,672,000. I left a zero out. No, I didn't. That looks good. Okay. All right. Donated pharmaceuticals and medical supplies were received and utilized as general expenses. So down here we'll have our general expenses. Will be 265. And this is going to be a contribution, right? So this will be kind of like revenue as a contribution. So contributions without restrictions. It's without, right? Yeah, without. Without. There we go. Without. Okay, so this is a revenue. Okay, remember that's a revenue too. Okay, so here we go. So Medicare, Medicaid, third-party payers approved and paid this amount of the 8222 bill. Is that what I had? That's not what I had here, is it? Oh, hold on. I tried to mess up. So this $9.6 million includes this charity stuff. So I actually do have to back those out, don't I? Okay. So yeah, I tried to mess up. So I got $9.6 million. Okay. We got to subtract out the charity cases. So our actual patient service care for Part A should be the 915. Okay. So this is 915. Okay. And that's going to change my amount here for accounts receivable a little bit, right? So if I subtract out the $928,000 for cash, getting ready to subtract that. Okay. Ooh, there we go. 8222 is our new receivable here. That's better. Now this is going to make some more sense. So there's that 8222 right there, right? So that's what you see. That's why I realized I made a mistake. So a lot of this pretty big contractual difference here. What do you call it? Contractual adjustment. Okay. So our contractual adjustment is going to be the 8222, and we're going to subtract from it, which we actually received of 5365000. So that's how much our adjustment is, contractual adjustment, right? That's contra revenue, needs to be debited. So let's do that first. Contractual adjustment. Okay. 2857000. There we go. Okay. This here was, paid by Medicare, therefore received by us. So that's going to be cash to us. Okay, 5365. Okay. And then we'll remove that entire receivable because we're not going to collect anymore, right? So the 8222, let's see, receivable. We'll remove the entire receivable, that 822200. Okay. So, pretty big write-off from, like I said, right? We're only going to get what they give us. All right. An unconditional contribution was received in cash from a donor to construct a new facility care for Alzheimer's patients. The full amount is expendable for that purpose. No activity has occurred during the year. So it's got a restriction, right? So we definitely, even though it says unconditional, it has to be spent on this Alzheimer's care facility. Okay, so we'll show the cash coming in. Not enough zeros. Okay, and then we'll have contributions with restrictions. One more zero. There we go. More cash received from different, what we got here? We got gift shop, cafeteria, medical seminars, unrestricted transfers, medical transcriptions. So this is all that other revenue. Okay, it's just other revenue. Okay, so we got cash coming in of $965, and we're just going to call it other revenue. Other revenues. Okay. Uncollectible accounts were written off. Okay. Uncollectible accounts totaling $32.50 were written off. Remember, we use the allowance method. Okay, so we need to reduce accounts receivable with a credit, and we'll do a debit to the allowance. Okay. So this is our allowance for uncollectible. Remember, there's no debit to an expense account here because that would have been pre-done in previous transactions whenever the allowance was set up. Okay, and then down here we have accounts receivable being reduced by the written off amount, and now we need to increase the allowance by $11.70. So this needs to be a debit to an expense account or provisions account, and then we'll credit that allowance to put more in it, okay, to increase it, okay? So we're going to increase this by doing a credit to the allowance account to increase, that's how you increase a contra asset, right, would be through a credit, $11.70. And then this will be that provisions for bad debt. That's kind of our bad debt expense. How will we name it here? Okay. So there's all of our transactions there. Let's see if I made any typos. I did not. All right. So let's do the bottom part. And we got to look at all the transactions up top to do the bottom part, right? So down here, net patient service revenue. Okay. So we'll start up here, and let me get my calculator. Well, you know what? Let's do it Excel with Excel instead. So let's see. I want to snap it in, just like that's perfect right there. And let's make this view very large, so it's easy on the eyes. Okay, so. Patient. Okay, we got to find. So what we're doing first? Net patient service revenue. So that's going to be patient service revenue minus contractual adjustments. Okay. So let's figure this out. It's a little bit too big up top, but we'll use a slider. So we got patient service rev. Okay. And let me make this bigger. And we figured that out at the very. It's in transaction A, and I didn't want to go back to this look. There you go. View general journal. There we go. And so that's that $9,150,000. Okay, so that's our 915,000. Okay, and then we've got our contractual adjustment. Okay, I'm going to put it as a negative. Let's make this accounting. I got to have it look reasonable, right? All right, and so our net patient service revenue is going to be this minus this, okay? That don't look right. Oh, I got to put plus. I put it as a minus. There we go. Okay. So it should look like that, right? That don't look right. What did I do wrong? This is not the right number. Here's the right number. Hey, I did it again. This number. So -2,857,000. There we go. So that is our net patient service revenue. Beautiful. Okay, now get back over here. 6293000. Okay, there's that. Okay, the only time we did provisions for bad debts was in 6B, and that's this number right here, right? 1170. Okay, and it says less. Let me put it as a negative, so it shows it in parentheses, right? 1170. Oh, that's not right. I hit numlock. Tries again. Minus. There we go. And now other revenue. Okay, other revenue. The only two that are going to show up. Now, yes, we have this as a contribution with restrictions, but when we do this, we only want the ones without. Okay, so this one here, it'll show up in there somewhere, but not when we're trying to do this. It'll show up more or less in the equity section as it will on this, what we're doing right here. Because it's not really from operations. So what we do have here, though, is this contributions without restrictions that came in as a donation. We got this donated revenue. Okay, so donated rev, okay, of 265. That's one too many zeros. Okay, and we also have our other revs. Okay, which is down here, the 965, right? So really it's kind of our total other rev, okay, is going to be these two added together. So $1.23 million. 1230123. And let's check that. That should be it. There you go. All right, very good. All right, so I'm going to just wrap that up for chapter 15. I have yet to decide on what we're going to do about the final. I'm going to do something today. It's probably going to be a lot of multiple choice, maybe some modified accrual entries in there, maybe some more of some of the enterprise, hiccups. Enterprise fund type transactions as well, but it's probably going to be majority multiple choice. I'll probably do it something similar to the auditing exam, which is going to be a time limit once you start. Probably give you an hour and a half, which would be more than enough time to complete it. And yeah, that's probably the plan. So once I'll try to have that up, and you should be able to see it. I might actually have it opened up earlier than auditing. So I'll have it the way you can start doing it on Sunday as well. That's my plan. Anyway, question number 2 before I forget. We got a second question for today. Let's do something fun, I guess. What's your favorite board game? How about that? Something different, right? Favorite board game. So, what's mine? I don't even know. I haven't played one in so long. You want to go to some of the ones like Monopoly or Trivial Pursuit. So, who knows? I used to like doing Pictionary, even though it's not really a board game. It's kind of board game-like. But anyway, just put in there maybe your favorite board game, or if you want to do like card game, like a Uno or Skip-Bo or something like that, I guess would be cool too. But anyway, so remember the first question is your closest hospital, what category it's in, and then the second one would be your favorite board game, guys. I appreciate you dealing with this strange time, and I hope you got a lot out of this course. The majority of it, even though was kind of glossed over towards the end, because of your sound accounting foundation, you should be able to figure it out without much effort once you got into the work environment anyway. I feel confident in your abilities. We will see some of you guys next fall. The rest of you that are moving on, God bless you. God bless all of you, even the students will be back in the fall. And we'll see you in the future. Thank you for our adventure this semester. God bless and goodbye.